So you filed your joint tax return, you're expecting a nice refund, but it just never shows up. It's like it vanished into thin air. Well, what if I told you it wasn't a mistake? It was taken by a system. But the good news is there's a very specific and pretty powerful way to fight back and get your share of that money back. Let's get into it.
All right, here's how we're going to tackle this. First, we'll look at the system that actually takes your refund. Then we'll talk about the legal idea, the key really, that lets you get your part back. We'll pull apart the exact form you need, Form 8379, and go step by step on how to fill it out. And finally, we'll see how this whole thing connects with some other more complicated tax situations.
Okay, so first things first. Let's dig into the problem itself. What is actually happening behind the curtain when a tax refund just disappears?
Right, so where did it go? This is the big question, isn't it? And the answer is, your refund wasn't lost in the mail? No, it was intercepted. It was taken by a powerful, fully automated federal program that's built to do exactly this. And that program is called the Treasury Offset Program, or TOP for short. Think of it as the government's master collection agency. If your spouse owes a past due debt, we're talking things like old student loans, unpaid child support, even state taxes, TOP has the green light to grab any federal payment heading their way. And guess what the #1 target is? Yep, tax refunds.
Now, the IRS isn't in the dark about this. They have their own internal tools. One of them is called Code IONOLI. Basically, when they process your return, this tool pings the Bureau of the Fiscal Service and sees if there's a debt flag on you or your spouse. If there is, boom, the system knows to grab that refund before it even gets close to your bank account. It's all built in.
Okay, so that sounds pretty final, right? An automated system that just takes the money. But here's the thing. It's not the end of the story. And that brings us to the solution, the real key to this whole puzzle. It's a legal idea called the Injured Spouse Doctrine.
So what does that even mean, injured spouse? Well, it's pretty simple, actually. You're considered an injured spouse if you filed a joint return and your share of the refund got snatched to pay off a debt that belongs only to your spouse. The injury is that your money was used for a debt that had absolutely nothing to do with you. And understanding this definition, that's your first step to getting your money back.
So how do you actually make this claim? You use a specific tool, IRS Form 8379, the Injured Spouse Allocation. You can think of this form as a kind of financial surgery. Its whole purpose is to carefully separate your income, your payments, and your credits from your spouse's on that joint return you filed together.
Now, this table right here, this is the heart of the entire form. It's all about these 3 columns. Column A is just the total amount from your joint return. Your entire job on this form is to prove how much of that total belongs in column B, your column, and how much belongs in column C, your spouse's column. And the golden rule is, for every single line item, what's in B plus what's in C has to add up perfectly to what's in A, no exceptions. So the form walks you through this process in 4 main sections. You have to allocate your income, then your adjustments and deductions, then your credits, and finally all the taxes and payments. We're going to walk through each one, starting with the most basic piece of the puzzle.
All right, let's get into the nitty-gritty, starting with the absolute foundation of this whole thing, allocating your income and deductions.
Now, the IRS has some pretty strict rules here. Certain types of income are what we call traceable, things like your W-2 wages or your Schedule C self-employment income. That money is tied directly to the person who earned it. End of story. But then you have joint income, like interest from a shared bank account. Here, you've got some wiggle room. You can decide how to split it, though, a 50-50 split is usually the most straightforward way to go.
And this can get really specific, especially with newer, more complex deductions. A perfect example is the Qualified Business Income Deduction, or QBI, from IRC Section 199A. This is a big deal for small business owners. If you claim it, you have to be super careful to allocate that deduction only to the spouse who actually owns the business that generated it. It really shows you the level of detail the IRS is looking for here.
Okay, so once we've sorted out the income, we move on to the next big piece, allocating the credits and the tax payments. This section is so important because it's where you really prove, hey, this is the money I paid in, and these are the credits I earned. It's how you show your direct contribution to that refund. When it comes to credits for your kids or for education, there's a very specific rule. You can't just split them down the middle. For things like the child tax credit or education credits, you have to ask, if we had filed separately, who would have been legally allowed to claim that dependent? Whoever that person is, that's who gets 100% of that credit, and all goes to them.
All right, now for the Earned Income Credit, or EIC, you get a bit of a break. You don't have to break out your calculator for this one. The IRS actually figures this out for you using this exact proportional formula.
And the logic behind this formula is really all about fairness. It makes sure the credit is split up based on how much earned income each spouse contributed. It stops a spouse who didn't earn any income from claiming a piece of a credit that was generated completely by the other spouse's work. Make sense, right?
Now, for tax payments, we see that same pattern again. Some things are rigid and some are flexible. The money that was withheld from your paycheck, your federal income tax withholding, that's not divisible. It's tied to your W-2. It belongs to you, period. But if you made joint estimated tax payments throughout the year, that's a different story. You and your spouse can agree to split those up any way you want.
But, what happens if you can't agree on how to split those estimated payments? Well, the IRS has a plan for that too. They have a default formula they'll use. It basically looks at what each of your individual tax bills would have been, and it splits the payments proportionally. It's the IRS's way of being the tiebreaker.
Okay, last section here, and this is really important to get. An injured spouse claim isn't some isolated thing. It can, and often does, bump up against some other really complex parts of the tax world. Just take a look at this list. A tax refund isn't always from simple paycheck withholding. What if a business loss creates a net operating loss, an NOL, that you carry back to a prior year for a refund? Well, that refund can still get snatched by the Treasury Offset Program. Same thing for refunds tied to things like the AMT or the net investment income tax. So you might find yourself needing to file an injured spouse claim in some pretty advanced tax situations.
And we have to talk about one last huge variable: community property states. If you're in a state like Texas, California, Washington, the rules change. The IRS has to follow your state's laws when it comes to dividing up income and property. This means that getting your state of residency right on Form 8379 isn't just a small detail. It can completely change the outcome of your claim. It is absolutely critical.
So, when you step back and look at the whole picture, it really boils down to this, doesn't it? Filing a joint tax return is great for saving money on taxes, most of the time. But what you're also doing is tying your financial life to your spouse's for that year. And as we've just walked through, that financial entanglement can have some pretty serious and unexpected results, especially when a debt from one spouse's past suddenly shows up to claim the other spouse's refund.